So the purpose of this short video is just to provide you with some context around why these trust rules were created. And hopefully if you can understand some context, you can get a better understanding of how to apply the trust principles and how those principles can potentially be abused in order to avoid tax. So just to illustrate this example, I'm going to use a family with a mother, a father, and 2 children, and those children are 4 years old and 6 years old. Now, as those children are growing up, the financial responsibility for them falls on their parents. Their parents are responsible for making sure the bills are paid, making sure their school fees are paid, etc., etc., and all the budgeting that goes into that. Now, if we have a situation where those parents passed away, let's say both of those parents died at this stage, with a 4-year-old and a 6-year-old, all the assets that those parents own, okay, all the assets that are sitting in their estate, would presumably be left to their children in terms of a last will and testament. Now, the problem with this situation is that those children are too young to take on the financial burden of budgeting and paying for all the expenses associated with them growing up. And so that is primarily one of the reasons why this trust structure was created. Now, the purpose of the trust structure originally was that instead of these assets being donated to the children, instead those assets would, upon the death of those taxpayers, go to a trust, and those assets would be managed by trustees. And the trustees would almost step into the shoes of the parents, and they would manage those assets for the benefit of those children. So they would make sure that there was enough money to pay for school fees, pay for all the other ancillary costs of those children growing up. So initially, the point of trusts was to take that financial responsibility away from the children into trustees that those parents nominated to manage those assets on their behalf. What has happened subsequently is that taxpayers, while alive, are using trusts as a mechanism to divert income that would normally accrue to them from assets into the hands of other beneficiaries. So potentially, trusts can be used as a mechanism to move income from your hands into the hands of someone else, and therefore you can save the tax in your hands. And so as a result of that tax avoidance scheme, SARS came up with this Section 7 ruling that we discussed a little bit in our donations tax section. So the whole purpose of this trust section that we're going to be starting now is to answer the following question. The income from these assets over here needs to be taxed somewhere. Must it be taxed in the hands of the taxpayers? Must it be taxed in the hands of the beneficiaries, or must it be taxed in the hands of the trust? And those are the questions that we need to be answering at the end of this trust section.